Risk management in investment portfolios. Here's the truth. Anyone can make money in the markets when times are good. But when the storm hits, when stocks crash, when crypto collapses, when the economy turns upside down, that's when real investors are separated from gamblers. The difference isn't luck, it's risk management. Without it, even the best portfolio can crumble. With it, you can survive downturns, protect your wealth, and position yourself to thrive. In this video, I'm going to show you exactly how to manage risk in your investment portfolio using the same principles professionals use to protect billions of dollars. Hey everyone, welcome back to the channel. If you're new here, please like and subscribe to our channel for more interesting videos. And I talk about money, investing, and building financial freedom the smart way. Today's video is about one of the most important topics in investing, risk management. Most new investors focus only on returns, how much money they can make. But seasoned investors know managing risk is how you stay in the game long enough to actually build wealth. So let's break down why risk management matters, the principles behind it, and the strategies you can apply to your own portfolio starting today. Why risk management matters. Let's start with a simple fact. Investing always carries risk. Markets go up, but they also go down. Inflation erodes value, companies fail, and unexpected events like recessions or pandemics can shake the entire system. If you don't manage risk, your portfolio is like a ship without lifeboats. One big storm, and you're sunk. But with the right risk management, you can weather those storms. You might take a hit, but you'll recover and grow stronger. Think about this. If you lose 50% of your portfolio, you don't need a 50% return to get back. You need a 100% return. That's why protecting the downside is just as important as chasing the upside. Number 1, diversification. The classic rule of investing. Don't put all your eggs in one basket. Diversification means spreading your investments across different asset classes, stocks, bonds, real estate, even cash. It also means diversifying within asset classes, different sectors, industries, and geographies. For example, if all your money is in tech stocks, one downturn could destroy your portfolio. But if you hold tech, healthcare, consumer goods, and bonds, the losses in one area can be balanced by gains or stability in another. Diversification doesn't eliminate risk, but it reduces the impact of any single failure. Number 2, asset allocation. Diversification is what you own. Asset allocation is how much you own of each. This is the foundation of risk management. Your mix of stocks, bonds, and other assets determines most of your portfolio's risk and return. Generally, younger investors with longer horizons can take more stock exposure. Older investors closer to retirement should lean more toward bonds and stable assets. A common rule of thumb, 100 minus your age equals percentage of stocks. But remember, this is just a guideline. Your goals, risk tolerance, and time horizon matter most. Number 3, position sizing. Even within an asset class, you need limits. Position sizing means deciding how much of your portfolio to put into a single investment. Putting 50% of your portfolio in one stock, that's gambling. Professionals rarely put more than 5 to 10% into a single company. The idea is simple. No single failure should be able to wipe you out. If one stock collapses, your portfolio survives. Number 4, stop losses and exit strategies. Risk management isn't just about what you buy, it's also about when you sell. A stop loss order automatically sells a security if it drops below a certain point. This prevents small losses from turning into catastrophic ones. But you also need exit strategies. Are you holding until retirement, until you hit a price target? Having a plan keeps emotions from taking over. Remember, emotion is the enemy of rational investing. Number 5, liquidity and emergency funds. One mistake investors make is tying up all their money in assets they can't easily access. That's risky. If you suddenly need cash, you don't want to sell investments at a loss. That's why you need an emergency fund, 3 to 6 months of living expenses in cash, or a high-yield savings account. Liquidity isn't exciting, but it's protection. It gives you the flexibility to ride out downturns without panicking. Practical strategies to apply today. 1, know your risk tolerance. Be honest with yourself. If losing 20% of your portfolio would keep you up at night, you need a more conservative allocation. Risk tolerance isn't about being brave, it's about being realistic. 2, rebalance regularly. Over time, some investments will grow faster than others. That changes your allocation. Rebalancing means selling a little of what's grown too much and buying what's lagged, bringing you back to your target mix. This keeps risk under control. 3, hedge with defensive assets. Assets like bonds, gold, or defensive stocks, like utilities or consumer staples, tend to hold up better in downturns. Including them in your portfolio can cushion losses when markets get rough. 4. Limit leverage. Borrowing to invest can amplify gains, but it also amplifies losses. Many investors go broke not because of bad investments, but because they took on too much leverage. Avoid margin unless you truly understand the risks. 5. Think long-term. Risk isn't just about volatility, it's about the chance of permanent loss. The longer your time horizon, the lower your risk of losing money in diversified investments like the stock market. Patience is one of the strongest risk management tools. Common mistakes to avoid. Let's quickly cover the mistakes I see most often. Chasing hot stocks or trends without considering risk. Ignoring diversification and going all in on one idea. Now, I'd love to hear from you. What's one risk management strategy you already use, or one you're going to start after this video? Drop your answer in the comments below. If you found value in this video, hit that like button, subscribe for more investing wisdom, and share this with someone who's building their portfolio. Thanks for watching, and I'll see you in the next one.